Topic introduces compounding as a fundamental concept in finance that describes how interest accumulates over time on both the original principal and previously earned interest. Compounding allows investments and debt obligations to grow at increasing rates because interest is earned not only on initial capital but also on accumulated returns. The topic explains the distinction between simple interest and compound interest, emphasizing that compound interest more accurately reflects real-world financial transactions. The frequency of compounding significantly affects investment growth and borrowing costs. Annual, semi-annual, quarterly, monthly, and continuous compounding each produce different effective interest rates, making compounding conventions critically important in bond valuation, derivative pricing, and financial risk management. The topic further discusses the mathematical relationships between nominal interest rates, effective annual rates, and continuously compounded rates. The effective annual rate reflects the actual return earned after considering compounding frequency, allowing meaningful comparisons between financial products using different compounding conventions. Continuous compounding represents the theoretical limit where interest compounds infinitely often and is widely used in financial modeling because of its mathematical convenience. Financial institutions rely on compounding formulas to value investments, calculate discount factors, and determine present and future cash flows. Accurate understanding of compounding is essential because small differences in interest calculations can generate substantial valuation changes over long investment horizons. Topic also examines spot rates, forward rates, par rates, and swap rates, which are essential components of fixed income markets and interest rate modeling. Spot rates represent yields on zero-coupon securities for specific maturities and form the foundation of the term structure of interest rates. Each spot rate discounts a single future cash flow occurring at a particular point in time. By combining spot rates across maturities, financial institutions construct yield curves used to price bonds, derivatives, and other fixed income instruments. Spot rate curves provide critical information about market expectations regarding inflation, economic growth, and future monetary policy conditions across different time horizons. The topic explains that forward rates are implied future interest rates derived from existing spot rates. Forward rates reflect the market's expectations regarding future borrowing and lending conditions between specified future dates. They are widely used in pricing forward contracts, futures, and interest rate derivatives. If actual future rates differ from implied forward rates, investors may realize gains or losses depending on their positions. The relationship between spot and forward rates is governed by no arbitrage principles, ensuring consistency across financial markets. Financial institutions monitor forward rates closely because they provide insight into expected policy changes, future liquidity conditions, and anticipated shifts in economic activity. The topic also discusses par rates and swap rates as important benchmarks in fixed income markets. A par rate is the coupon rate that causes a bond to trade exactly at its face value because discounted coupon payments and principal repayment equal the bond's market price. Swap rates represent the fixed interest rates exchanged for floating payments in interest rate swap agreements. These rates are determined using spot rate curves and market expectations regarding future interest rates. Swap markets are highly significant because they allow institutions to manage interest rate exposure efficiently. Banks, corporations, and investors use swaps extensively for hedging, asset liability management, and speculative positioning. Topic also focuses on the shapes of yield curves and their economic interpretations. Yield curves graphically display the relationship between interest rates and maturities for securities with similar credit quality. An upward-sloping yield curve, the most common shape, indicates higher long-term interest rates relative to short-term rates and often reflects expectations of economic growth and inflation. A downward-sloping or inverted yield curve occurs when short-term rates exceed long-term rates, frequently signaling economic slowdown or recession expectations. Flat yield curves suggest uncertainty regarding future economic conditions. Yield curve analysis is therefore an important tool for investors, policymakers, and financial institutions evaluating macroeconomic trends and interest rate risks. The topic further explains that yield curve movements are influenced by monetary policy, inflation expectations, economic growth prospects, liquidity preferences, and market demand for fixed income securities. The expectations theory suggests yield curves reflect anticipated future short-term interest rates, while the liquidity preference theory argues that investors demand additional compensation for holding long-term securities. Market segmentation theory proposes that supply and demand conditions within specific maturity sectors influence yields independently. In practice, yield curve behavior often reflects a combination of these explanations. Understanding the drivers of yield curve changes is essential because shifts in interest rate structures significantly affect bond valuations, derivative prices, and institutional funding costs. The topic concludes by emphasizing the interconnected nature of compounding, interest rate structures, and yield curve analysis within financial markets. Compounding principles determine how cash flows evolve over time, while spot, forward, par, and swap rates provide the framework for pricing fixed income securities and interest rate derivatives consistently. Yield curves summarize market expectations and influence portfolio management, monetary policy decisions, and corporate financing strategies. Financial institutions rely heavily on these concepts to manage interest rate exposure, construct hedging strategies, and evaluate investment opportunities. By integrating compounding techniques with term structure analysis, risk managers and investors gain deeper insights into valuation dynamics and broader macroeconomic conditions.